Okay, so you're asking about buying above bar 18, swing stop below bar 1. What is the expected target? Since swing trade is high probability, what is the risk reward ratio that can make it work? Well, that is not so easy. So let me get rid of some of this stuff, make it a little easier. So here's the thing. Okay. Here's today. Here's bar 18. I'm assuming you're talking about bar 19, which is this bar right here. So, well, there's a couple problems with this. And I'll add the grid, so I know a lot of people like that. So let's just kind of take a minute and look at the open. Bar 1, these bars trend from the open, but look where the moving average is. We're far away from the moving average. Price is forcing you to buy very high in the moving average. In 15-minute chart, we've been hammering back to the moving average every time we break out. So here we're probably going to have to test back to the moving averages. And by the way, this is the 15-minute moving average on the 20-period moving average for the 15-minute chart. Anyways, back to what you're talking about. Trend from the open, you buy climax, bad follow through, so we may have to test down. And there is the chance that we break below bar 1. So a swing trader who's long, and I'm going to get to your question, this will help kind of drive your question home. If you're long, stop below here, probably better here. Bad follow through for the bulls, sideways, not good for the bulls. And look, you can notice, well, actually it's over here. So arguably a higher low, but very minor. You have to ask yourself, especially here and here, we've had 1, 2, 3, 4, 5, 6, 7, about 8 bars sideways. 4 great bull bars, pretty good bull bars, and about 7 bars sideways. So you have to ask yourself, is this going to be a trend or a trading range? For the bears have a, you can argue, failed breakout here and a second failed breakout. You have to be suspicious about, we got a bull breakout here and bad follow through. So there is the very reasonable chance of this. So think about this for a minute. If you're a swing trader, what are the odds, if you think this is a trading range, what are the odds we get back to the open today? It's pretty decent. Maybe 50-50. Look right here. Broke up, tested back to the open. So for a trader who's willing to let's say sell somewhere in here, and whoops, let me redo this. For a trader who's willing to sell, and especially risk up to here, they've probably got a really good chance. But put it this way, what are the odds that we get back to the open of the day? Well, if you notice, it's basically twice the risk. Arguably, let me just do this a little easier. Here's 2 times the risk of this signal bar. Why is 2 times the risk of shorting here, your initial risk from this high to this 1 tick below? Why is it basically at the open of the day? There's no coincidence. Yeah, if you put your stop up here, your risk is obviously the low of the day. No coincidence either. So what you have to understand is the bears have they have low probability but very good risk reward. Sell below here, stop a few ticks maybe above the high of the day, and they're betting on the open of the day and maybe even a test down. So when we get to here, and here's another problem. Trend, if you were betting on a trend from the open, here's a higher low, here's a higher high. You don't want price to fall down below here. Now, if you put your stop one tick below here, it's a trading range, so you're probably going to get stopped out, so you'll have to look to re-enter. So, look right here. We fell this far down, tight channel. You can argue a high 2 buy, 2-legged pullback. Here's a high 2, bad follow through, breakouts in the moving average, bad follow through. So it's maybe an okay swing buy. We have a double bottom, breakout below double bottom, so wedge, first push, second push, third push. If we fall below the wedge, we may get a measured move of this. And you can see, pretty much got that. So anyways, back to what I'm talking about. You have to understand, is the market always in long or short? I don't know. Arguably, it's always in long. Some traders will see it as always in long until we fall below here. But it's not 60%. The bulls have a swing buy from here. This is also a breakout test of here. The bears have a swing sell. So, flip a coin. It's not. Well, your question, you're asking about the probability of stop low here. If you bought up here, stop low here, well, yeah, it's certainly higher than putting a stop below here, but it's not 60%. And maybe it is at this moment. But look right here. Now you've got a double top. The math is not 60%. It's a trading range. And you look right here. And here, well, I'll point this out first. Bulls bought this close. Notice the bad follow through. Why did price only go one tick above this close? Bulls bought. If you bought this close for a scalp, disappointed, tried to get out break even on this bar, it let you. You didn't have that long. Arguably you had one chance, maybe a couple as this bar was forming, because price only went one tick above and turned down. Traders that did not take that opportunity may be trapped. So maybe a trader, and there we go. Maybe a trader bought this close and added on more here. Well, there's their break even. Excuse me, there's their break even point on the entire trade. Sorry, my voice is a little hoarse. And as you can see, they couldn't get out. So you have to understand, bulls may be trapped. Therefore, we may test if this is a trading range, we may test the other extreme and fail. So the bears see a channel. So this really isn't, for me, I think it's better to get out below here. So if you buy the, I would simply, maybe go for something like this. Go for something, twice your risk up here. But I would certainly probably get out below this bar because it is a wedge, and we could go for a measured move down. And here's kind of a hint. So we have a double top trying to form a double bottom. Look how many bear bars we're getting. Just bull breakout, bad follow through, bull breakout, bad follow through. It's not great. So what you're asking about a swing trade, let's use this right here. So here was I think it's Fed minutes. It was Wednesday. If you were to buy stop above, buy on a stop here and put your stop one tick below here, the probability may be maybe 60%, arguably. I'd say more 50-50, because it could easily fall below and turn up. But if you were to put a stop down here and buy above, look where it took you. There's 1 times the risk. You know. Here is, so in general, it's better to use the swing stop. And this morning, here's a much greater example. So arguably trim from the open, bar 1, always in long above bar 1. All right. Here's arguably a high 2. Well, let's say someone was to buy above, put their stop below, they get stopped out. And then let me put it this way, if they buy above here, get stopped out, they have to buy again up here. Sometimes difficult to do. Likewise, a trader could buy above and put their stop down here or down here and hold. It's higher probability because the odds are you won't get out, or you won't lose. Same thing with, well, here if you buy above this stop below, you get stopped out. But if you bought above this bar, you may get stopped out. But if you use the correct stop, you won't. So in general, I mean, and just kind of in theory of it all, if you were to do that and just walk away, that's tough. I think I would look for something somewhere up here, maybe a measured move based upon these bars. I'd go for a measured move. I'd go for a big target if I was to take that trade. So otherwise, you just get out early. So I hope that helps.